This video is how to use Binance's arbitrage trading bot. I'll show you how to open a trade using this bot and then exactly how it's working under the surface to carry out this arbitrage. An arbitrage being where the trader takes very little to no market risk, but earning a positive yield out of the trade. I'll leave timestamps below. We can get to the arbitrage trading bot by going to trade up here and then trading bots and arbitrage bot. I'll leave a link below to a Binance beginner's guide if you don't have an account yet, and a link below to a deposit and trading bonus for Binance and the other exchanges I use. You can check the details below for those links if it's available for you. Now, right here, what we're doing is carrying out two separate trades, but Binance creates this, as you can see here on the right-hand side, with one trade. So essentially all we have to do is choose the asset that we want to trade and then create it. And it actually carries out everything for us just by pressing this, which is really good because otherwise it does take a little bit of effort. So firstly, what exactly is this arbitrage trade? Well, actually, it's a very well-known and well carried out trade within crypto, and it's known as funding rate arbitrage. This is where we try to earn the funding rate paid in the crypto futures market or the derivatives market. Many people trade in that market, but there is this funding rate that is paid. And so what we want to do is earn that funding rate, but at the same time, we also want to not actually own the asset. We want to take a delta neutral position, meaning, yeah, we want the funding rate, but we don't want to take any market risk. We don't just want to buy the asset. So this is how the trade actually works out. It's known as a delta neutral trade. So what we do is we take $1,000 or whatever amount, right? We go long. So we go and buy the asset, let's say Bitcoin here. We also, in the futures market, take the corresponding side of the trade. So we go short $1,000. So you're long $1,000, you're short $1,000. So you have what's known as a delta neutral trade. In theory, it doesn't matter what happens to the price of Bitcoin, because if it goes up, one of the sides, wins, the long will win and the short will lose. And conversely, if it goes down, the short will win and the long will lose. But we don't care because that's essentially delta neutral for us, right? So we win and lose the exact same amount on both sides of the trade. And so we don't make any money either way. We don't lose any money either way. But what we want is the yield that is paid in the futures market, and we are earning that. So what we're attempting to do is take very little to no market risk, but earning the funding rate that is paid. And as you can see, that can changes every day, every week. But for right now, Bitcoin about 3%, ETH 7%, and then you've got some other assets here, 10%, and some other altcoins may have higher amounts and lower amounts, but you can see all of that here. So that's what we're trying to do. You can also see that in the crypto industry, any asset that trades with futures will have a funding rate, as you can see here. So they're all laid out. This is a very normal thing within crypto. Now, what is the funding rate? Well, a derivatives market trades off of the price of a real asset. So you have the crypto asset, in the spot market. Derivatives market is completely synthetic. People just trade the price. And so because that market isn't the underlying market, it has to be kept in line, the price, with the underlying spot price. And the way that the exchanges do this is through the funding rate. So if a lot of buyers come into the futures market and push up the price over and above the spot price, the derivatives price is too high. And that's not good because it creates, two markets that are different. The derivatives need to be the same price as the spot price. So buyers come in and push it up in the futures market. The exchange says, look, we can't have this. So we need to punish you for buying up and pushing the price up. You have to pay this funding to the other side of the trade, which are short sellers. So if we're short, we are getting that funding rate paid to us by the buyers. And so that's what we can have. Now, of course, we may not want to be short the asset. So that's why we have the delta neutral trade to try and balance out any price exposure whilst getting the funding rate that the exchange is making those buyers pay. Now, conversely, on the other side, if sellers are coming into the futures market, pushing the price way down below the spot price, then there's too many sellers and the exchange is going to make those sellers pay the buyers coming in. So buyers will come in and they can get the funding rate from sellers. So it can be paid by longs, it can be paid by shorts. So there is risk here that the yield changes over time. You can see that there is different yield across here. For the most part, within crypto, funding is positive most of the time. Slightly positive, maybe highly positive, but during bear markets, you might get negative funding for periods. Most of the time, it is either neutral to positive though. So even though this is supposed to be an arbitrage trade without any risk, we are still exposed to the funding rate changing over time. So that's something to be aware of before trading. Let's go ahead and open a trade using the arbitrage bot then. And what do we need to know about? Firstly, Binance lets us carry out two types of trade here. One is positive carry, one is reverse carry. Positive carry is the normal type of trade that most people will use. We're buying in the spot market and we're taking a synthetic short position in the futures market and we're getting paid on that short position. Most people do this because funding is positive for most of the time in crypto. You do get areas where it's negative, but mostly it's positive. And so people will carry out this trade. Reverse carry is completely different. It's the other side. So you've actually got the crypto asset already. You sell it in the spot market to raise cash to then go ahead and long in the futures market. People don't really do this. It can work out, as you can see, but what you're doing is trying to long the asset in the futures market, earning funding from short sellers. Most people carry out the positive carry trade as funding is positive most of the time, so this should give us the better yield overall. So from here, we can choose any asset. Doesn't matter what the asset is, it matters that it pays a decent yield from funding reliably. So I'll show you with ETH as an example. These are the two sides of the trade, but again, it doesn't matter. We can just press create on the bot. This is the funding rate history over time. It looks fine. Now what we're doing here is taking a short position in the futures market, buying spot. You can see that Binance is using a little bit of leverage on the short side. This is okay for this type of position because what they should be doing is using the ETH in the futures side as account equity. So if the price goes up, our long side wins and we get more account equity, and the short side will lose, but we've got more equity, to fund the trade with. The only thing with 2x leverage is that potentially if the price does rise very high, very quick, you could potentially get a liquidation there. That's not like the end of the world. It just means that if the short side was liquidated, you would then just have the long position there and you'd be long the asset and then you'd have a risk position. But with the spot side going up in price, then you should not have too many issues. So the 3-day APR you can see is 7%. Now the reason Binance is using leverage here is because if you're using leverage on the short side, it means that you can put less down and you can put more into the long trade. And so you can increase the nominal size of your position. So you're earning 7% on slightly more than you have cash to fund the actual trade. From here, there may be a minimum amount that you can invest, but we can just press create. This is what's going to happen. So we'll put it in, press confirm, and it should carry out the trade for us. The funding rate on Binance is exchanged between longs and shorts every 8 hours. And so you, of course, have to have the trade running for a period of time. But for right now, we have an amount, our total investment, and every 8 hours, the funding will be swapped. Now, as long as the funding is in our favor, we're short. So we're looking for positive funding to get that funding from longs. So as long as that's in our favor, we will receive that. Now, of course, if funding goes against us as well, that will take out of any potential yield that we're getting from this strategy as well. So that's working. You don't have to carry out both sides of the trade, working for us. And if you want to end it, just press end it here, press confirm, and that will get out of both sides of the trade for you.